This video will deal with perpetual inventory systems. Perpetual suggests that it's continuous. It runs continuously. And it's a way of monitoring stock in the stores continuously, as opposed to, say, having a stock take once a year or twice a year, or some sort of periodic stock taking system. The perpetual inventory system is one that's running continuously. So it's a method of recording material transactions. For example, material receipts, material issues, and the current stock balance. So it's materials in, material receipts, materials issued, which is the outgoing materials from the stores, and the current stock balance. So those three figures are important in any store's management system. It's what's coming in, what's going out, and the balance that's remaining. The perpetual inventory system removes the need to close the business for stock taking. Some companies, when they stock take their stores, they may be able to do it over a weekend when no production would take place, and ask the staff to come in for the weekend and perform the stock take. In other words, count up what's in the stores and see if it tallies with what's on records. But the perpetual inventory system, because it's running continuously, it means the business doesn't have to close, or it doesn't have to have perhaps an all-night stock take or a weekend stock take when the business would not be running. So it's continuous, and therefore it should be up to date at any moment in time. It's a system of ascertaining current balance after recording every receipt and issue of material through stock records. So in other words, what's recorded on the stock records should accurately reflect what is in the stores. It should specify exactly the amount in the stores, and it should be accurate. The perpetual inventory is usually checked by a program of continuous stock taking. So having said it's a paper-based system that checks the paperwork to make sure everything balances, it is backed up by continuous stock taking, perhaps on a low scale. Perhaps some members of staff dedicated to just checking stock to make sure that the records are accurate. So there may be continuous stock taking running in parallel with all of the other functions that the stores undertake. Perpetual inventory means the system of records, whereas continuous stock taking means the physical stock checking of those records with actual stocks. So we have a slight difference in nomenclature here. The perpetual inventory system is really dealing with records, perhaps the stock records on a bin card, and that may be compared with the stock record held in the office of how many items should be in stock. And if everything balances, if the two items balance, if records going to the office suggest that so many items are required, and at the same time those items are booked out in the stores, then the two figures should tally. However, as we'll see, they may become out of sync for various reasons. They may not be balanced for various reasons, and for that reason alone it's necessary to have this background check running, perhaps on a very low level, perhaps just a small number of staff continuously checking to make sure that the stock records in the stores are accurate. Now, the perpetual inventory system comprises of a comparison of bin cards. These are the cards on the physical bin where the stock item is held, or the equivalent wherever the bin card is held. It may be held in some area where the items are very large, but it's still held in one particular place, and the store's staff understand where all of the bin cards are and where they're held. So it's a comparison of the bin cards and the store's ledger account. So the store's ledger account is quantitative, but it's also value. It also shows the value of the stock. So there's a comparison here between what the bin card says. The bin card says so many should be in the bin, and then the store's ledger, which shows what should be in it according to the receipts and according to the withdrawals, according to the production system that the system processes, how many have been withdrawn for production, and the balance should be what's in stock. So the two accounts should balance. The continuous stock taking is physical perpetual inventory. That's when, as I said, some members of the store's staff may be engaged in checking stock. They may randomly check particular items, or they may systematically work their way around the stores, checking bins and checking the amount of raw materials and work in progress that's held within the store. And then, of course, comparing that with what the records say. If there is a discrepancy, clearly what is physically in the stores should be the figure that is kept. But there should be some explanation as to any discrepancy, of course. It may be due for various reasons. So a comparison of bin cards and store's ledger account. Well, the bin cards is maintained by the storekeeper, and the store's ledger account is maintained by the store's accountant. So there should be different staff doing this. Obviously it depends on the size of the business, the importance of the stores, and what items are stored in the stores, and the value of the stock in the stores. But generally speaking, there should be two, ideally, because that's how items, when there's a mismatch, are flagged up before it causes damage to, say, production or to customer orders. So the bin cards are generally maintained by the storekeeper, and the store's ledger account is maintained by a store's accountant, who will monitor the amounts that should be in stock, and then the two items can be compared. Each item of stores is recorded at these places simultaneously. Normally the balances shown by the two records tally. They should tally, they should be the same, but the transactions should be recorded simultaneously at two different points. And again, the balances should accord, should be the same. If there's not, if there's an imbalance between the two, then something has gone wrong, and that warrants investigation. However, there may arise some differences between the two records due to the following reasons. There could be an omission of an item of stores in bin card or store's ledger account. Sometimes people overlook booking a particular item. They may forget about it or be distracted by something, and the bin card goes back and it hasn't been adjusted. Items have been issued, but the bin card hasn't been adjusted, let's say. Or it could happen on the ledger account as well, that items received in a dispatch note, which shows the amount of items going into the stores, it wasn't recorded. It wasn't recorded because the personnel who deal with that may have been distracted or working on something else, or be called away on some other issue. So for whatever reason, there may be an omission of recording, and that will lead to a mismatch between the two sets of records. And again, that should flag up that something needs to be done. It could be wrong posting of an item of stores, either in the bin card or in the store's ledger account. Sometimes mistakes can happen. Sometimes the stores manager, the stores clerk who deals with the bin cards may misrecord the item. The item is meant to be taken out, and the bin card shows it as incoming. It just simply recorded in the wrong column. Can happen. Again, the two accounts will be out of balance. They won't agree, so it should initiate or start off a process of investigation to see what's happened, what's the difference, and why is the difference there. So that should be flagged up very quickly when the two accounts are reconciled. When they're reconciled, the figures should be the same. But as I said, sometimes perhaps goods coming inwards are booked as goods going out of the stores, or vice versa. So it could be a wrong posting. It could also be an arithmetic error in working out their balances. The records should be reconciled at frequent intervals, and correct balances should be drawn. Sometimes when staff are booking out items and they need to subtract the amount booked out from what's shown in the bin, the total quantity available, it may be an arithmetic error. They subtract it and they make a mistake. Again, it leads to a difference between the two sets of accounts, and that should signal that some investigation is required. Find out what happened, why did it happen, why was the mistake made, and what can be done to ensure that it doesn't happen in the future. Now, physical stock verification. Well, the perpetual inventory system is not complete without systematic procedure for physical verification of stores. It's important that stores that are holding perhaps many, perhaps even thousands of items, and some of them high value, the stores should have a process of verifying its stock, verifying that its records are accurate. This could be done by continuous counting and checking and weighing, and it could involve some members of staff who are dedicated to checking the stock levels to make sure that the stock records accurately record what's there. But it's important. The correctness of balances as shown on the bin cards or store's ledger account should be verified by means of physical stock verification. And as I said, sometimes stores do have a small number of staff working continuously, just checking the records to make sure that physically what is in stock accords with what the records say. And any discrepancy should be flagged up immediately for action. Physical stock verification may be conducted in the following two ways. Periodic stock verification could be that the store's manager simply requests store staff to check items once a week, just check selected items once a week. The items checked could be randomly selected, or it could be done on some historic basis, which items have not been checked for a long time. Whatever the means is, there could be a periodic stock verification, or there could be, as I was suggesting earlier, a continuous stock verification where a small number of staff are continuously working on checking the records against the physical stock to see if the two tally. Now, periodic stock verification, it refers to a system where physical stock verification is normally done periodically. For example, once or twice a year. It doesn't have to be once or twice a year, it could be once a month. It depends on the size of the stores and depends on the value of the items in the stores. If the items are very costly, very expensive, then the store's manager will want to keep a very accurate set of records to make sure that there's nothing untoward happening in the stores. There's no pilfering, for example, or the items in the stores are secure, but also secure from damage and secure from perhaps the impact of climate or whatever it is. Depends on the nature of the stock. Under the method, the periodic stock verification method, value of stock is determined by physically counting the stock on a particular date. It's usually at the end of the year, but it could be, as I said, could be any time that the store's manager deems fit. There should be a logic in the date selected, of course, and sometimes it's done when perhaps the stores are quiet. There's not a lot of activity within the store, and the staff are then turned over to checking stock to see what's available and checking the veracity of the stock records to see if they're accurate. It's a simple and economical method of stock taking, and it's adopted by small concerns. Small companies tend to use this. Small companies don't really want to close the business for a few days while the stock take, and they may not want to have dedicated staff running all the time checking stock, so they would just have periodic stock checks just to give them confidence that their records are accurate. This type of verification is good only for the items which do not find place in the perpetual inventory records. For example, work in progress, components and consumable items. So this type of verification is generally good for items such as work in progress, components and consumable items. It's important that the store's manager knows exactly what needs to be checked and what has been done by one system as opposed to another. So the onus is on the store's manager to optimize the use of labor within the stores and use it in a way which will lead to accuracy in the records and avoid stock out or indeed overstock in some areas. Now, the limitations of the method, well, the stores may be closed down for a few days to facilitate stock taking. If it's a periodic stock check, it may be that the stores have to close for a few days to check it. It depends on the extent of the stock take. It could be, as I said earlier, just some members of staff working on stock checking on a continuous basis. That is their job, just checking the stock to make sure that the records are accurate. And that could be the way it's done, in which case the stores would not close. It's just the stocks are checked. There is a possibility of fraud, discrepancy and so on. So again, the storekeeper will have to have some system in place to avoid pilfering or damage to stock or misuse of stock. So it's important that the stores operate a secure policy towards the stock. Now, continuous stock verification. Well, this system comprises of counting and verifying a number of items at random daily intervals, perhaps throughout the year, so that the items of store are verified several times during the year. It's just continuous. It means some members of staff just check the stock on a particular time and write it onto the bin card that the item was checked on that date, and let's say the items in the bin accord with what was on the card. So it's just written and their initials put on it and the date. So there is a record that it's been checked. And then another bin would be selected and checked as well. So it's continuous. It's a rolling process. Notice of the particular stock to be verified each day is given by the storekeeper only on the day of actual verification. It's important that the storekeeper does not give the checkers advance notice, just in case there is some issue about pilfering or misuse of stock or whatever it is, that they should check on a particular day at that time. And it does not give anyone a chance to take stock from elsewhere and replenish a bin and falsely report perhaps what is in stock. So it means that the stock take is more secure just by the storekeeper picking the date and informing the stock takers as to the date and the items to be checked. There is an element of surprise in this type of stock taking. It gives more control over the items of stores, and that control is good because it leads to more accuracy in the recorded figures, and it avoids conflict between the two sets of records, between the bin cards and perhaps the store's ledger account. So the two items should balance. The system does not necessitate the closing down of stores to facilitate stock taking. So continuous stock verification runs in parallel with all the other functions of the stores, issuing items and taking returned items and booking back returned items and looking for faulty items and reporting them, and all the normal processes of the store. There's less possibility of fraud and discrepancy, but the method is expensive and is adopted by big organizations only. Generally speaking, the big organizations are capable of funding this type of continuous stock verification. But as I said earlier, it's also related to the value of the stock. It doesn't mean that the stores has to be very big. The stores, in fact, could be quite small, but the items held in stock could be very valuable. Perhaps, for example, in the jewellery trade, it could be precious metals. And clearly, they must be checked, and there should be very accurate records kept between what is recorded as stock and what is actually there. The actual stock of materials should not differ from the recorded stock under normal circumstances. It should accord if everything goes to plan. If the figures are accurately recorded in a way that the items issued are accurately deducted from the balance, and if there is no fraud or if there's no issues, the figures should accord. Sometimes differences arise, and they could arise for the following reasons. There could be breakages or wastage of materials due to improper handling. That will lead to a difference between the two sets of records. What the storekeeper has would be broken items which are of no use in production. What the store's ledger is showing are perfect items. So that needs to be reconciled, and both sets of records should be adjusted accordingly and remedial action taken. But there can also be shrinkage and evaporation. It depends on the products we're talking about. We tend to consider stores as dealing with physical, tactile items. The items stored could be in liquid form and they could evaporate. So at the end of a certain time period, there's less in the store. Not because it's been pilfered or damaged or misused, simply because it's evaporated. Or it's changed form because of over time it's changed. Depends on the nature of the product. There could be loss due to accident or fire, or just something which is exceptional, but it means a difference between the two sets of accounts. The store's ledger account will show what's come in, and we'll expect that to be the figure. The items in the stores, which are now damaged or are not of good quality, those will be different. So the two sets of figures will be different, and they need to be reconciled. Sometimes there are loss arising out of breaking up bulk materials. The company may buy materials in bulk, depends on the nature of the material, but when the bulk is split, there may be wastage in dividing it up. And this can happen in all sorts of ways. The company may have, for example, it may buy metal strip of a certain length, but it requires length of a particular length of strip, I should say, and it doesn't divide equally into the lengths both, so there will always be some wastage, and that perhaps will go into a separate stock of metals or of items which can be returned or which can be sold elsewhere in a different market. But it doesn't mean because the company buys in bulk that there won't be wastage when it gets to the company, because the storekeeper and his or her staff will have to divide up that bulk into units that are useful within the company, which may mean there's wastage on the bulk. There could be losses due to theft. We may as well face the truth. Sometimes staff will steal particularly valuable items that they could sell on. It could be metals or some items that they can sell on. And the temptation is there, and the store manager and the staff working with the store manager have to be alert to this possibility. Sometimes bin cards or store ledger cards can be sent in the wrong area or misfiled, and because they're misfiled they get mixed up with another set of stock, and the two figures are mixed up and misrecorded, and for that reason there's a mismatch again between the two sets of records. There could be an issue of over or short issue, which will lead to differences in the accounts as well. Sometimes issuing staff in a store may give a few extra to the production, just in case. Well, those few extra have not been booked out. The order was for so many, and the number issued was perhaps a few extra. Those few extra over time will mean a big discrepancy perhaps in the stock. So there should not be that sort of discretion given to the staff. They should follow exactly what the records state. If production requests a certain amount, exactly that amount should be issued. In that way, all of the figures within the company will tally. Now let's look at the advantages of perpetual inventory systems. First of all, there is easy detection of errors. Errors and frauds can be easily detected at an early date. Because the two records don't balance, it flags up there is an issue, so errors, fraud, or whatever the reason can be flagged up at an early date. There's better control over the stores. The system exercises better control over all receipts and issues in such a manner as to give a complete picture of both quantities and values of stock in hand at all times. So there's a better control over the stores. There's two sets of records pointing at the stores, and the two should be balanced. The two should be equal. If they are, then the stores is running smoothly. If there are issues, there should be a means by which those issues are flagged up early so that remedial action can be taken. There should be no interruption of the production process with the perpetual inventory system. The physical verification of stock is made on a planned and regular basis, so production should not be upset by this. So the company should not have to close for a few days and production stand idle for a few days. So the machines and the labour and all the processes that go to make up the final product that the company is making, those should run smoothly, even though the stores are in the process of checking stocks. It does act as an internal check. Records are made simultaneously in bin cards and in store ledgers account, which act as a system of internal check for detection of errors. So there is an internal system that's running, and it's running from two parts, and the two parts, when they're joined up, the records should be the same. If they're the same, there's no issue. It's working perfectly. If there is a discrepancy, some investigation as to why the discrepancy took place, and then the accurate figure that's physically in the stores, that's the one that should be taken. Now, material management. Well, the investigation in materials is kept at a minimum level as the actual stock is continuously compared with the maximum level and the minimum level. So given that there is a system in place for continuously checking the stock, then the stores manager is able to work out precisely what is being used, what's the rate of usage, what's the minimum stock level that's required given lead times on deliveries, and what's the maximum stock that they should have. So there's more control over materials because there's more information flowing back to the required personnel, the people who make the decisions about stock levels. Early detection of loss of stock due to, for example, shrinkage, evaporation, accident, fire, theft, and so on, can be easily detected. I mentioned these earlier. But any discrepancy between the two sets of records should flag up an investigation, and the investigation may indicate what has caused the discrepancy, which may be due to a variety of reasons. It does lead to accurate and up-to-date accounting, so that it's useful because it means that this part of the organization is reporting accurate figures, and then the management focus can move to production to make sure it's got accurate figures, and to the administration and to the various functional areas of the business to make sure that they are working effectively. But at least this system doesn't guarantee, but it tends to give confidence that the stock records are accurate because of the double check. It's possible to prepare periodic profit and loss account and balance sheet without physical stock taking being made, because when the accountants need to work out the final accounts for the business, they need to know what the stock is, what the opening stock was, and what the closing stock is. Well, if the figures are being continuously checked, then at any one moment in time the figures should be accurate. So that figure can be easily reported to the accountants for inclusion in their final sets of accounts. In other words, no big effort has to be made at one particular moment in time. Perhaps the business temporarily closed down while stocks are checked, because the stocks are accurate, or they should be accurate under this system. Availability of correct stock data. Well, correct stock data is readily available for settlement of insurance claims, for example. If there's an issue where the company has to claim, or it has to claim against insurance or against a supplier or whatever it is, there's accurate figures, and the system within the stores enables those figures to be extracted very easily and quickly, efficiently, and reported to whoever requires them. Employment of specialized staff. Well, since the work is spread throughout the year, whole-time specialist staff can be engaged for the purpose. Since Perpetual Inventory system is running right throughout the year, it's perpetual. And because of that, then specialist staff can be brought in, people who are able to check perhaps tolerances on deliveries, who are able to read gauges, who are able to monitor the stocks in almost a technical way as well as a quantitative way. So there's much more accuracy about the quality of the stock and what's been bought in. And of course, moral check on employees. The system acts as a moral check on the employees working in the stores, which increases their efficiency. The store manager knows how many bins, let's say, have been checked in the last week, and is able to compare that with the previous week and the previous month. So there's a way of ensuring that the staff are properly allocated and utilized. And the staff themselves know that they're doing an important job, so they should be more motivated to get accurate figures back to the management. In addition, the particular checkers, the staff who are checking the bins, will be asked to sign off for the figures that they're reporting. And if subsequently it's found that those figures are inaccurate, then there is a trail back to that person who signed off the figures in the first place, who will then have to account as to why he or she signed off inaccurate figures. Was it because they were not motivated on the day, or they made genuine mistakes, or what caused the problem? The following disadvantages of excessive stock are avoided. So sometimes companies can hold excessive stocks. Now this is dealt with in other videos on the course, but excessive stocks means that the company has invested in stock which is standing idle. So in other words, that capital is not helping the business, it's just sitting in the stores. That would be excessive stock. So there's a loss of interest on capital locked up in stock. That the amount of capital, the amount of money in the stock that's not being used, that could be in a bank earning a rate of interest. And it's better to get the rate of interest than simply having the stock sitting in the stores. Of course, it's a bit more sophisticated. The particular item in the stores may be appreciating in value. Perhaps the price of the item is rising in the market, in which case having it in the stores may be the best idea, rather than having that capital in the bank. If the bank is giving 5% return per annum and the stock is appreciating at 10%, then have it in stock, because the value of the stock is rising faster. So a balance has to be struck, but certainly the management should compare the amount in the stores with what could be achieved by using that amount in an alternative investment. There is also the possibility of loss through deterioration. Some items may be perishable, and they're stored in stock, and when they're acquired, they may not be of any use. They have deteriorated. Now, it depends on the type of materials we're talking about, and you can dream up examples for yourself here. but some items that go into the stores may not last, particularly say food items or some chemical items or this sort of item going into the store. it may deteriorate over time. So holding a lot of it is not a good idea. There's also the risk of obsolescence. If the store holds a lot of an item and there is some sort of innovation so that the product that's been produced is varied, the item held in the stores may no longer be required. Now, if the stores is holding a lot of it, that may mean a loss for the business. So the rate of innovation or technical innovation of products may determine the amount of stock as well. It's certainly a factor that must be taken into account when deciding on the optimum stock level. Such losses increase the cost of production. They may be in the form of wastage, scrap, defective, or spillage. So there are all sorts of losses that can occur within the store's environment. They arise in almost all manufacturing industries, and there is no uniformity in their accounting treatment. So, in other words, the perpetual stock taking approach may reduce the possibility of this happening. It may try to stop overstocking, because overstocking can lead to these various issues. Steps should be taken to minimize the discrepancy between records so that efficiency can be increased and proper material control is ensured. So the moral of the story is that the two sets of records should correspond. But excessive stock control, trying to avoid a stock out, may be inefficient, and it runs the risk of the item becoming obsolete because of innovation or technical change within the company, because it deteriorates over time, depends on the nature of the product we're talking about. And also, of course, we must balance that with what could have been achieved with that capital had it not gone into the stock. The idea of putting it into a bank and earning a rate of interest, let's say. This is a concept known as opportunity cost. Number 1 on the slide here is known as opportunity cost and is dealt more effectively in economics, where that concept is very important in the study of economics and crops up all the time. There are classes on the meaning of opportunity cost, and you should seek those out. But that's all we're going to deal with in terms of perpetual inventory control, so let's leave it at that and say thank you for watching.